this is John Bartlett from Brentwood Growth. We're doing another one of our episodes on sale or scale, and I'm pleased to have with me Jack Werner from HomeX Services. Jack, how are you today?
I'm doing great. Thanks for having me.
Sure, thank you for doing this. And where are you calling from? Where's home base for you?
So it's funny. We started our business in Chicago. We're up to about 1,500 employees in total,
Wow.
and we're down to 2 employees in Chicago, which is a longer story. But I'm in cold Chicago today.
Well, good. So let's start the way we normally start this. Tell us a little bit about your background and how you got to the group and who the group is and the types of sectors and the types of businesses you guys are looking to buy and partner with and grow.
Sure, very very happy to. And lot of ways we could take that question. So happy to go kind of whichever direction makes sense as well. I'd say so. We're in the HVAC, plumbing, and electrical business,
Okay.
doing residential and commercial work.
Okay.
And there's a lot of private equity firms in our industry.
Yeah.
We're actually not a private equity firm. We're a family business, and that was an important part for me of why I got into this as well.
Mm-hmm.
So I started my career, like a lot of folks do, on Wall Street.
Mm-hmm.
But I always had this nostalgia for family business. So we had a family business in my family that made ladders. And hopefully for folks who are listening or in the trades, they've got a Werner ladder on their truck or in the warehouse.
Right.
Hopefully none of that Louisville nonsense.
Yeah.
So that was a family business started by my great-great-uncle in 1921. My grandfather's generation ran it. My dad ran it for a while.
Right.
And they wound up selling it in the late 90s, early 2000s to a private equity firm, which is a whole other story.
Another story into itself.
Wound up eventually going bankrupt, actually, which was a very painful chapter for everybody.
Oh, I'm sorry about that, man.
There's good and bad.
Yeah, you put a lot of debt on this stuff, and the businesses can have their ebbs and flows, and debt payments can be made, and sometimes they can't be made, and stuff happens.
Yeah. But so family business was always kind of this nostalgic thing in the rearview mirror for me. And, my dad, who wound up being the main founder of our business, went and ran a kitchen and bath manufacturer afterwards.
Mm-hmm.
So for folks in the plumbing world, I'm sure they're familiar with Gerber Plumbing.
Mm-hmm.
And he kind of fell in love with this industry and wanted to build a different kind of business in it. So he called me up back in 2016,
Mm-hmm.
looking for some help, kind of sketching out a business plan for this industry.
Mm-hmm.
And I couldn't turn that down. So I started working with him in 2016 when it was really an idea. And we've grown that idea from, a piece of paper to a business that is in 6 states, almost $400 million of revenue, 1,500 employees. And importantly, a company we're really proud of with great values that treats people well and creates opportunity for employees. So I left out a lot of details, but that's kind of the big picture.
Yeah. So when you say a family business, I mean, this truly is a family business with you guys putting your own capital in and building the platform out yourself, coming out of the trades. And that's very different from a lot of consolidators that are private equity backed. And so
It is.
Yeah, and
Sorry.
when you're talking to potential sellers and you're talking about the background of the firm and where your dad came from and how you got into the business, how are you comparing and contrasting yourselves to, private equity buyers, and how's that resonating with potential sellers?
Sure. And for transparency, we took on a minority partner who is a private equity firm. Family's still the majority control, but I do want to, full disclosure, mention that. How do we articulate our story? How do we tell our story to people? I think for us, it's really kind of 2 things that stick out. And it doesn't mean private equity firms can't do this, but sometimes not all of them do. I think the first is really having a long-term orientation.
Mm-hmm.
So, the ladder business was in our family for 75 years.
Mm-hmm.
We started this business in 2016. There's a lot of PE guys, not all of them, but plenty, who are looking to do a quick flip.
Right.
And that's just not in our DNA. So that's one difference.
So let me expand on that a moment. So they're looking to do a quick flip because they've raised capital from investors, and investors have a timeline that they want the money invested, and they want to see the money grow, and then they want within 5 to 7 years they want that capital returned back to them so that they can reinvest it in maybe a similar strategy or other strategies. So it's not like the private equity guys in themselves are just saying we got to flip this stuff. They've got investors that they have to answer to.
Exactly. So that's one difference. And then the second is really a focus on people.
Mm-hmm.
So, we had a saying in our old family business that you take care of your people take care of your customers are going to take care of your bottom line.
Right.
And particularly in this industry where we don't have any patents or special technology that somebody else doesn't have.
Right.
Ultimately, it's a people business.
Yeah.
And kind of with that family business mindset of, let's really make sure we create opportunity for people. It doesn't mean you don't hold people to a high standard or you never fire somebody, because that's important too. But really that focus on people and developing them, I think can be different in more of a family business mindset than a private equity investor.
Yeah. Well, that's great. So HVAC, plumbing, and electrical, or just HVAC and plumbing?
We do all three.
You do all three, both on the residential side and on the commercial side.
That's right.
Okay. So in terms of the types of businesses that have interest to you, can you talk a little bit about the size of the business, what you want the revenue mix to look like, what you want the infrastructure to look like, what the owner dependency of the business could be? What are some of those high level filters that you guys process through to determine, yes, this looks interesting, no, this is not a good fit?
Absolutely. So before getting into some of the specifics there, I'd say our North Star is growth.
Mm-hmm.
So the most important question we ask is, if we partner with this owner, can we turn their business today into something that's 2 times as big or 3 times as big 5 years from now?
Right.
And that's really the lens by which we look at the rest of the business. So size plays into that. A business that is $2 million revenue, sometimes you're not buying a business as much as a job.
Mm-hmm.
So for guys who have a business in that scale, I'd maybe ask yourself that question of, what does succession planning look like? What happens if I go away? Because from a buyer's perspective, we'd love for the seller to join us and stay around. They don't always want to,
right? Or
they may not. Some guys go from being an entrepreneur for 30 years to having a boss. That's a tough transition for folks.
Tough transition, yeah.
And it doesn't work for everybody, and it doesn't mean somebody was wrong. It's just not always the right fit. So typically, the larger a business, the more infrastructure it has, and the more ability to support growth it has.
Mm-hmm.
And that's not always the case. So sometimes we'll look at a business that might be, $20 million revenue,
mm-hmm.
and has 25% bottom line margins.
Mm-hmm.
And some people will look at that and say, this business is so profitable, that is top of my list, I would love to buy that business. That's not the approach we usually take.
Right.
Because when I see margins that are that high, usually what that means, not always, but usually, is they haven't invested in that management team. They don't have the infrastructure for growth. And so if we want to take that from 20 million to 50 million, probably the margins are going to come down.
Right.
So we love, businesses that have really good service in the field, have really good cultures, have really strong brands, but that need some help growing. And so that could be a $20 million business. It could be a $100 million business, but as long as we're kind of set up to grow it, that's key.
And when you look at the growth potential of a business and you look at a founder owner and you look at the reasons that maybe he has not maximized the growth of the business and the areas that you guys want to focus on, is it he's not investing in the marketing enough? He doesn't have the sales process. He doesn't have the pipeline management, or is he doing all those things properly, but he doesn't have the resources and he can't recruit and he can't build up the team both in the office and in the field to be able to grow? And so is it the sales and marketing piece that you see as the bigger hindrance, or is it the lack of recruiting and sort of the ability to expand the internal people infrastructure?
Frankly, it's often a little bit of both.
Yeah.
And I can give a couple examples. So our first partnership was with a great company in Rhode Island called Gem Plumbing and Heating.
Mm-hmm.
Gem was about half commercial, half residential, run by three brothers, Larry, Lenny, and Eddie. Great guys.
I live in Boston and I see their trucks all the time.
Good. And Lenny really ran the commercial and the construction part of the business. And the commercial business more than doubled in the first 2 years we partnered with Lenny. Mm-hmm. And I'd like to say it was because, we had some great strategy for growing that business.
Right.
But we didn't. What we had, and Lenny will use some different language to describe it, which probably not good for this podcast.
More colorful, perhaps.
More colorful. It's a question of risk tolerance sometimes.
Right.
And if you're, an entrepreneur on your own, it can be hard to take the big swing, to bid on the big project, to invest in marketing, when at the end of the day, you don't have a backstop.
Right.
And so sometimes partnering with a bigger firm, the owners know what they need to do to grow.
Right.
They're just making a rational decision that they can't take that risk on their own.
Yeah. A lot of times they're having to put their personal capital, their personal balance sheet on the line to be able to take that next swing. And when they measure the risk and measure the impact, if it doesn't work out, they say, well, there's plenty of upside here, but there's risk as well. I'm just not willing to take that risk.
Absolutely. And then on the other side, there are lots of instances where we can bring more resource to help the business grow, and really operational expertise. Mm-hmm. So our CEO, Brian Alexson, who's incredibly strong, mm-hmm. Before he joined our business, he grew his last business from 30 million in revenue to 600 million.
Wow.
And you ask him how he does it, and it's really a lot of blocking and tackling. Mm-hmm. And so it's resources, we call them centers of excellence, that we use to support all of our companies, mm-hmm. on sales and sales training, mm-hmm. on marketing and marketing excellence, mm-hmm. on purchasing, on mm-hmm. HR, on IT. Mm-hmm. And so you asked a little bit earlier, what might be different about approaches between some firms. Some firms will take an approach of, hey, we're going to, partner with or acquire a bunch of businesses all around the country and kind of let them do their own thing. And they're going to be a federation of different assets, right. different businesses. Our approach is, if we're going to partner with somebody, we're going to really be partners and bring our resources and expertise to help them grow. And that's been a big piece of our growth as well.
Got it. When you look at the revenue mix, when you look at the new construction exposure, when you look at the retro replacement piece, when you look at the service maintenance piece, do you have any guidelines in terms of like how much new construction that you're willing to take, or how much you want the business to be in service and maintenance work?
So our business today is about 50% residential, mm-hmm. Service and install for Mr. and Mrs. Jones. It's about 40% light commercial, mm-hmm. so commercial service, rooftop change outs, PMs. Mm-hmm. And it's about 10% construction.
Got it.
We like being about 50-50 residential and commercial for us. Mm-hmm. We're big believers in doing both. Mm-hmm. We found it helps us manage the seasonality better. Mm-hmm. Mm-hmm. So when the heat wave strikes and the phone won't stop ringing, we can take guys off of commercial projects because they're longer dated, right, and capture that demand. And when it's, a beautiful October day in Boston and it's 65 degrees and everyone's playing outside, right, we can move, 20% of the residential guys onto the commercial side and really give them, we talked about creating a great place to work, give them a consistent 40-hour work week. So for us, as we look at companies, right, if a company's doing all residential or doing all light commercial, mm-hmm. we like both. Both fit our strategy.
Got it.
We do try to minimize the new construction to a degree,
Right.
but not all new construction is created equal. You know,
Right.
there's some construction out there that's at a 40 or 50% gross margin with builders who pay their bills.
Mm-hmm.
And I think some of the PE guys who, look at that with horror,
Right.
frankly, are wrong. There's a lot of good business there as well. So we're a more flexible buyer or partner as it comes to mix.
What about parts of the country, geography? Where within the U.S. would you consider buying a business?
So as I mentioned, we're in 6 states today.
Mm-hmm.
We're in Massachusetts, Rhode Island, Connecticut, New York, New Jersey, Pennsylvania. So really all throughout the Northeast.
Mm-hmm.
For us, we're big believers in density, especially with our kind of operationally focused approach.
Mm-hmm.
So we're really still focused Northeast and Mid-Atlantic. But I'd say, something that fits every piece of our strategy except for geography, we'll always still look at as well. So
what
if
about union versus non-union?
We're non-union.
Non-union.
There's plenty of great union businesses out there.
Mm-hmm.
I think you either are or you aren't,
You're right.
more or less.
You've got to pick. Size of business. How large will you go, and how small will you go?
The largest company we've partnered with was 70 million in revenue
Mm-hmm.
at the time, and we'd be open to going larger for the right partner.
Right.
And there's really no lower limit for us. But
Mm-hmm.
what I go back to is, if it's an owner and 3 techs,
Mm-hmm.
we'll kind of run the math of, what investment would we have to make
Right.
to hire 3 techs and, gain that market share, investing in marketing.
Right.
And that's not usually a multiple of EBITDA kind of investment.
Right.
So if a guy's looking for a great home for his techs, or his employees, and for his customers, perfect for us.
Got it.
If he's looking for a big price and he's $1 million of revenue, that's usually a little harder for us.
Got it. Talk to me about deal structures. We like to talk about the headline number, but then there are different components of the headline number in terms of how the deal gets structured, in terms of the cash piece, in terms of potentially a seller's note, potentially earnout, potential rollover equity. How do you typically structure a deal, and what flexibility do you have in the structuring of that deal based upon where that owner is in life and what it is that he's trying to accomplish through this transaction and transition?
Sure. So you asked about flexibility. The phrase I sometimes use is a Chinese menu. So there's, you go to a Chinese restaurant, there's 400 different options. I try not to give sellers 400 options, but we are pretty flexible.
Mm-hmm.
And there's a cash component, there can be an earnout, there can be equity,
Mm-hmm.
there can be a seller note that's
Mm-hmm.
debt, there can be a convertible note if we want to get really exotic here.
Right.
Ultimately, we're trying to get the seller what they're looking for, and also something that aligns the incentives. So if it's a young owner who sees a ton of upside still and wants to be a big part of driving it, well, then maybe we should have an earnout for this business,
Right.
or an equity so they can share in that growth. If it's a owner who's in his 70s and looking to really retire and pass it on, then those probably don't make as much sense.
Right. Equity rollover is a new concept for a lot of our sellers. And can you explain in your own terms how that's structured, and if a seller is willing to not sell the entire business but roll some equity over, what the growth potential of that rollover equity is and how that ultimately gets monetized?
Rollover equity is complicated.
That's why I'm asking you.
Yeah. And I think if you're a seller, you should think long and hard about it.
Okay.
And I say it's complicated because, cash is cash.
Right.
A dollar cash worth a dollar
Right.
cash.
We know what that is.
Cash is good. People like cash. Equity, there's the opportunity for great upside,
Mm-hmm.
and there's the opportunity to lose money.
Right.
And frankly, we often struggle with equity because I think a lot of sellers will discount equity to be worth less than cash.
Mm-hmm.
We often think of equity as being worth more than cash.
Mm-hmm.
And so in a lot of situations, it actually doesn't make sense for us to include it. If you're a seller, I would ask questions about, what class of equity is it?
Mm-hmm.
So if you think about, a large company, they might have different classes of equity that have different seniority, which means,
Right.
This slug of equity gets
Right.
paid before this one.
Right.
And you don't want to be at the bottom of that list.
Right.
I'd also ask about, okay, what is your company look like? So what is your EBITDA? What's the multiple you're assigning to that? How much debt do you have? The EBITDA that a buyer is going to use for their own business, I can almost guarantee is going to be at a higher multiple than what they're giving the seller.
Right.
And that's appropriate because the larger you are, by and large, the multiple goes up. You look at the
Yep.
EBITDA multiple of the S&P, it's
Yep.
probably mid-20s. So
Right.
it's an appropriate thing to do, but you don't want to be in a situation where, the seller's being valued at 4 times and the buyer's being valued at 30 times.
Right.
And so the equity is not really worth anything.
Right. Right.
So equity is complicated. We like it in some situations. It does take more explanation, and sometimes you do something like a convertible note, which
Right.
is like the equity upside,
Right.
but has the downside protection.
Yeah. Yeah. Good. Good. Okay. So we submit an offer. Everyone understands the deal structure. The offer is accepted. We get into sort of the Q of E and the due diligence and the legal piece of the process at that point. What does that look like from a seller standpoint, and how long does that process typically last when someone's selling a business, partnering with you guys?
Sure. I think it usually takes, call it 8 to 10 weeks
Mm-hmm.
for that process for us.
Mm-hmm.
The Q of E's, that stands for quality of earnings.
Mm-hmm.
We'll bring in an outside accounting firm, and it's really almost a check the box exercise to make sure the numbers are
Right.
what we collectively think they are.
Right.
Some sellers think of a Q of E as a proctology exam. Our goal is for it to be more like a dental cleaning. It's unpleasant, but not that unpleasant.
Yep. Yep.
The legal work, we've done 15 or 20 partnerships over the 10 years we've been around.
Right.
So our documents are pretty down the middle.
Right.
And pretty tried and true. So there's work to do there, but
Yep.
it's not crazy. And then the third piece, which you didn't mention, is really operational. And that's where we spend a lot of our time.
Got it.
And that's focused both on making sure we can have a smooth integration. So spending time thinking about things like the employee health insurance and the 401k. And
Right.
if we're going to change things, making sure the employees aren't taking a step back.
Right.
But then, as I mentioned at the start, really focus on the growth.
Right.
So maybe we look at the sales team and they're closing at 20%.
Right.
Okay, great opportunity. We're
Right.
going to focus on that.
Right.
Maybe there's something on marketing, maybe on HR. So we spend a lot of time really laying the groundwork for that growth too.
So that process can take, as you said, anywhere from 8 to 12 weeks, 2 or 3 months or so. Let's call it. How do you ensure as we go through this process that customers don't find out, competitors don't find out, and at what point through the process is an announcement made to the employees?
It's a great question, and it's frankly, I think, an area where, as an industry, we struggle. The amount of gossip and dumpster talk, as we call it, is kind of off the charts.
Yeah.
I do go back to I think there's a quote about recessions that economists have predicted something like 15 of the last 3 recessions.
Right.
So yes, there's always a rumor that so-and-so's business is for sale.
Right.
And I kind of encourage sellers to kind of take that approach. So don't lie to somebody.
Yeah.
But there's always rumors floating around, and that's all right. Customers typically don't hear about it.
Yeah. What about employees?
Employees might, and depending on the situation and the team and the size of the team, it often makes sense to kind of bring in your next level of managers.
At what point do you bring them into this conversation? Do you bring them in a month before closing? Do you bring them in a week before closing? Do you bring them in the day before closing? When do you bring them in?
There's a tension because sellers would often like to tell people the night before.
Right.
Because they're worried about it. They want the ink to be dry.
Right.
And buyers would often like, the team to know day one.
Right.
So that they can help with the diligence process, and also so buyers can assess the team, which does matter.
Right.
I think what we found is, if you can bring in as a seller, your CFO to really help you with the financial pieces, that's going to make a big impact. And maybe you have 1 or 2 key managers you can bring in. And then typically what we'll do is, the week before an announcement, we'll get together with the senior team once, it's clear we're closing and no one's concerned about it.
Okay. Perfect. Okay. The deal closes. It's the next day. What does life look like? How does life change for the employees, and how does life change for the founder that just sold his business and got a check?
So you make the announcement to the employees, and the employees listen for about 60 seconds.
Right.
And then they start thinking, what does this mean for me?
Right.
And so we try to have a really good answer for what that means for that employee. So we'll bring in breakfast, and we'll have, depending on where it is, maybe we'll have a raffle for some stuff, and there's a new truck.
Right.
But we'll immediately kind of lay out the vision of where we want the company to go and why those people are key for it. And even little things like, day one, we'll be telling them, hey, your medical premium used to be $1,000 a month. Now it's $600.
Right.
And so there's going to be change, but we've got your back, and we've got the owner there standing with us, kind of saying the same. For the owner, it depends a little bit based on their stage of career and what they want to be doing.
Right.
I'd say typically for the owners who stick with us, and that is our preference, we like to say that, often before a transaction, their hair is on fire because they're doing 300 different things and they're wearing all these different hats. And so our goal is to remove a couple of those hats.
Right.
I give you an example. We partnered with a great business in New Jersey recently called Princeton Air Conditioning. Scott Needham, guy who's running it, mid to late 60s, great guy, kind of doing everything for the business. Still wants to work, but tired of doing health insurance renewals and commercial insurance, workers' comp audits. And so Scott took on a role with us after the integration of being a commercial salesman. And he has never been happier.
He's sort of back where he started probably 20 years ago, 30 years ago.
Absolutely. He loves dealing with his customers. He loves dealing with his employees. He doesn't want to deal with all the nonsense. So we took those hats off.
Right. Well, that's awesome. Well, this has been very helpful. So if a founder is thinking about selling the business, say in the next year or so, what things would you encourage that founder to think about that maybe they're not thinking about currently in terms of is the business ready to go through this process, and are they ready to go through this process?
It's a great question, and one I think sellers do themselves a big favor by asking. If I were that seller, I think about a couple things. I think about, is this a job or a business? As kind of one frame of reference. So, is there a team to support the business if I were to go away? I think about how clean are the financials? Because there's, often a lot of times we'll talk to a seller they think their business is making 15%, but the tax return shows 2%. And it can be a tough bridge to go from 2% to 15%, even if it's all real.
Right.
Maybe there were some cash jobs and it went under a mattress somewhere. So I'd encourage them.
Personal expenses are getting run through the P&L. Maybe there's.
I've never seen that.
Never seen that. Oh, okay. No, it doesn't happen.
not in our industry. Come on.
Yeah, I hear you, man. I hear you.
So I'd think about, even if it means paying more tax for a year,
right,
trying to have the numbers be clean,
right?
Because if you're getting a multiple on it, who cares ultimately at the end of the day?
Yeah.
And then I just have the hard conversation with yourself of are you ready for it?
Are you ready?
And because it's such an emotional decision too, and guys kind of downplay that till they're at the 11th hour, and then it's this is my whole identity. Am I ready for this?
Yeah, emotionally, mentally, spiritually, is your personal life ready? Is your marriage life ready? Is your family life ready? I mean, there's a lot to think through.
Absolutely.
Yeah. And if someone's thinking longer term, they're not ready to sell in the short term, but they're thinking about, 3 years out, 5 years out, 10 years out. What are the things that you would encourage those founders to be concentrating on to best prepare them to make the business as valuable as possible and make the business as marketable as possible to guys like you?
And the simple answer is that, the best thing they can do is build a great business, which is probably not a very helpful answer. I think our industry is going to continue to consolidate, and being a business that is easier to integrate than harder is great. So we're on Service Titan and Intact for our software.
Right.
It's easier to partner with a business that's using that same software.
It's there already.
If you've got some kooky, crazy compensation program that's very out of market, that'll be a yellow flag.
Right.
So trying to make it so it really fits seamlessly into the broader industry, I think is helpful.
Right.
And then the other thing I'd say is, particularly for non-private equity firms, but I'll include private equity firms as well. Buyers don't really like to be sold as much as to choose to buy. And that's true in mergers and acquisitions, as true as it is for selling a mini split to somebody. So meeting the potential folks who might want to buy your business and having them kind of fall in love with you beforehand, whether you hire a Brentwood Growth to help you in that process or you do it direct, if people already know you and like you, that's going to drive a much higher value and much higher likelihood of close than if you send a teaser to 100 people who've never heard of you, and they gotta send a bid by Tuesday.
Right. It's like so many things in life. You begin building relationships and you nurture those relationships so that when the time comes, it's not the first conversation the two of you have ever had.
Yeah.
Well, that's great.
We're finalizing a letter of intent, knock on wood, tomorrow. We started talking with the seller, I think it was December of 22.
Yeah, it took 2 years.
That's kind of extreme, but that happens.
It happens. Well, listen, man, this has been very helpful, and I appreciate your time, and there have been a lot of really good insights that you've given us. We'll put your contact details in the show notes here, and if anyone chooses to, they can reach out to you directly and begin that relationship as you're describing there.
Sounds great. Thanks for having me, John.
Okay, man. Thank you so much. Have a good day.
You too.
Later.